Hello everyone, welcome to the November market review. In October, we saw both equities and bonds fell because of a rising US Treasury yield, because of expectation that regardless of who will be the government, Democrats or the Republicans, there will be a fiscal expansion, meaning that the government will actually issue more US bonds, leading to an increase in that yield. Now, however, in November, we actually see a reverse. US Treasury yields actually fell, and on top of that, the overview of the US economy is better, and this actually led to more investors and business confidence in the US. Equities and fixed income rebounded, and in fact, US equities saw its best performance year to date in November, led by small cap stocks. And if we look at the Russell 2000, which tracks the 2000 smallest US companies, it actually went up by almost 11%. Now, comparatively, the Russell 1000, which tracks the US 1000 largest stocks, actually rose by 6.44%. Now, in fixed income, as I mentioned, the lower treasury yields and the narrowing of the corporate bonds due to a stronger view of investors' confidence on business benefited longer duration bonds as well as those that actually hold corporate bonds. And in our final point, as a takeaway, it is a good, powerful reminder that November highlights the importance of staying invested, which helps to capture the market gains as well as avoid missing any key opportunities that can significantly impact your long-term wealth. Now, moving on straight away to our market index performance. First of all, let's look at the S&P 500 index, which tracks the US top 500 companies. You can see among all the indexes, the S&P 500 actually did the best, thanks to the view that Trump's policies, which includes tax cuts and deregulation, will benefit the US companies, driving the S&P 500 index up by 5.87%. If we move on to the MSCI World IMI Index, which effectively tracks the 99% of the investable market capitalization of the developed economy, it actually went down a lot, but to a lesser extent compared to the S&P 500, going up by 4.78%. Why is this so? Mainly it's because of the negative impact of both Europe and Japan equities in US dollar terms. Now, let's explain what is going on in the Euro area first. Going to the Euro area, European companies actually in Euro dollar terms has risen by 1.1% using the Stock 600 Euro index as a measurement. But the Euro dollars has actually depreciated against the US dollar by 2.8%. Now, this leads to a negative returns in US dollar term of about 1.7%. So what leads to that depreciation of the euro dollar? Now, firstly, Europe's growth has been slowing down, and that actually weighed on the euro dollars, leading it to a depreciation. And secondly, there are worries that the Trump's policies of increased trade tariffs would actually negatively impact the Europe companies as well. This also drove down the euro dollars, leading to a depreciation of the euro dollars of 2.8% against the US dollars. Now, moving to the east in Japan, in contrast to the euro area, Japan has a different situation. First of all, the Japan's most referred index, Nikkei 225 index, actually has fallen more than 2%. Now, however, its Japanese yen has actually risen against the US dollar by about 1.5%. Now, first of all, let's go through what's going on here. Why has the Japan equities fell? Again, due to worries of a trade barrier, increased trade tariffs by Trump, and Japan companies' largest trading partner is actually US. This also lead to a worry that the exports to US would actually significantly decrease, impacting the earnings. This drove down the equity prices in Nikkei 225. Now, for Japanese yen, because of a recent report of a stronger inflation, leading to the expectation that the Japan Central Bank would actually hike interest rate, and this led to about more than a 1% rally of the Japanese yen against the US dollar. This effectively lead to the Nikkei 225 in US dollar terms dropping by less than what is in the Japanese yen of slightly about 1.1%. Moving on to the MSCI Emerging Market IMI Index, we can see that compared to its developed market counterpart, it has actually fallen by 3.4%. What is going on here? Again, if we look at the MSCI emerging market, the largest weight it has in terms of a country is actually China. And China equities has actually fallen because of, again, two reasons. First of all, the ongoing Trump's tariffs has weighed on the Chinese stocks. And on top of that, weak earnings coming from all the tech companies like Pinduoduo, Alibaba, and Baidu has actually, in fact, weighed down on the MSCI Emerging IMI Index. Pinduoduo and Alibaba, the two largest e-commerce, has fallen about 20% and 11% respectively due to a weakening consumer confidence. Yes. And for Baidu, due to the weakening of the business confidence in general, Baidu saw its advertisement revenue actually weakening as well. If we move on to just companies itself, the top companies like the TSMC and the Samsung Electronics has also fallen in November due to the concerns of a Trump tariffs. Overall, the MSCI All Country World IMI Index, which tracks the 99% of the investable market capitalization of both the developed and emerging economies, has risen by 3.9%, driven mainly by the rally in the US stocks. Moving on to fixed income, the Bloomberg Global Aggregate Bond Index has risen by 1.19% thanks to lower US Treasury yield as well as a narrowing of the credit spreads. Moving on to dimensional funds, both the dimensional equities and fixed income outperformed the market indexes. Looking at the global targeted value and global core equity, the global targeted value outperformed by the MSCI World IMI Index by about 1.8%, and the global core equity outperformed the MSCI World Index by 0.25%. Now, why is this so? Due to its tilt towards a small cap to capture the small cap premium, and this leads to an overweight in both the industrial and financial sector and an underweight in the technological sector. Now, if we move on to the next slide, you can see that this slide compares the Russell 1000 US large cap sector weight and the Russell 2000 US small cap sector weight. We can use this as a proxy to understand the weights of the dimensional small caps in the different sectors. And in terms of performance, we are using the S&P 500 Select Sector Performance to look at the returns of different sectors. Now, first of all, you can see the Russell 2000 US small cap has about 6% higher sector weights compared to the industrial, whereas the financial is also roughly about the same. But compared to the Russell 1000, the Russell 2000 grossly underweights the technological sector, which means that in November, because the two of the strongest performing sector we are looking at is the industrial and the financial, which the Russell 2000 US small cap has overweight in, as well as the dimensional equity funds. And not the one at the bottom, which is the technological sector, even though they did very well, only came in about 5.09%, which is much lower compared to the rest of the sector. These three reasons are why that the dimensional equities actually outperformed. Now, if we move on to the dimensional emerging market funds, what we see is that the dimensional emerging large cap core equity fund actually also strongly outperformed the MSCI emerging market IMI index. Now, this is because the dimensional emerging large cap core actually has a higher weight towards value stocks, and this means underweighting in stocks like the TSMC and Samsung Electronics, the technological sector, which actually fell quite drastically because of the worries of Trump tariffs. And the outperformance is about 1.8%, 1.89%. Now, all in all, we look at the dimensional world equity, which have weights in both the developed market and emerging market. You can see that the world equity has outperformed the MSCI All Country World Index IMI by about 0.56%. Now, moving to the fixed income asset classes, you can see that the dimensional global core fixed income outperformed the Bloomberg Global Aggregate Bond Index by about 0.3%. The reason being, the dimensional global core fixed income has longer duration, as well as higher weight in corporate bonds to capture the credit risk premium. And this means that the fall in US Treasury yield and the narrowing of the corporate credit spread has actually benefited the global core fixed income more than the Bloomberg Global Aggregate Bond. November serves as a powerful reminder for everyone that staying invested is extremely important. And in fact, November has been the best performance for the developed market equities year to date. And this means that missing these key months will significantly impact your long-term wealth. As you can see from this chart, which is the Russell 3000 index, which tracks the US equities in general. By missing just a week of the best performance from 1998 to 2022, you will see your returns where you invest $1,000 from the start of 1998 drop from $6,356 to $5,304 just a week. Now imagine missing by the month, the best month, you would see your performance drop from $6,356 to $5,076, and more for 3 months and 6 months and so on and so forth. So I'll hand this over to my colleague Alvin, who will be talking more on the market debrief. Thank you.
All right, thank you, Choon Siong. Hi, everyone. Thank you for joining us once again for our market update for the month of November. My name is Alvin, and I'm a client advisor at Provident. So I'll be walking you through the market debrief for the month of November. As what Choon Siong has shared with us, as investors, we can be happy because we have seen our equity investments went up, and our bond investments should have went up as well. So it's very natural that investors will ask the next question. Since market is so high now, should I invest my money now? Okay, so a lot of times people have this thinking is because they think of the stock market as a gravity concept. They feel that whatever goes up must come down. So that is the gravity concept. But really, if you think about it, the stock market is really more like a weighing scale. Okay, so why do I say that the stock market is really more like a weighing scale? Because the stock market will weigh the value of all the companies in the stock market based on all available information. And this can be seen in the more classic example of what has happened during COVID-19. So what has happened during COVID-19? Okay, so why did I say that? If you look at the stock market in the year 2020, around this period of time here, you realize that this February to March period was the time that the COVID has just hit the US market. and the government was considering to lock down the country because of COVID to minimize the spread of the virus. You realize that because there is fear of how companies will do in terms of their revenue because of the COVID, or how businesses will be impacted by the COVID virus, you realize that the stock market started plunging down from between February to March 2020. Okay, so after that, about 1 month of market coming down, people very soon realized that the impact of COVID-19 was not so drastic. People were still spending money, and people were even spending more money during COVID when they were at home. They were still doing online shopping. There was still demand for goods and services. So that's why you realize that the stock market very quickly rebounded. And that is the reason why I say that the stock market is really more like a weighing scale. But for investors, they are still concerned about investing at market high. Let's take a look at this chart in my next slide. Okay, so this is the return of the S&P 500 from about 1920s to 2020. So how to read this chart? Basically, if let's say you had invested after a sharp decline in the market, this blue color bar chart shows you how much return you will get after 1 year when investing during sharp market declines. You realize that on average from 1926 to 2020, the average return after you have invested during market decline is about 11.69% annualized. Okay, that's not bad. But okay, so there is this fear that if let's say I invest in market high, then what if market were to come down? You realize that data will show us instead that the market actually gave a higher return after investing into the market after market highs. What I'm trying to say here is not to try to pick when to invest into your investments, but what I'm really trying to do here is to show you the impact of if you have invested before market decline versus if you have invested after market highs. Okay, so the blue chart, as we know, is if you have invested after market decline. The green bar chart shows you how your returns would have looked like after you have invested during market highs. Okay, so the next section over here in the middle section, it shows you the return 3 years later after you invested during market declines. You still get a 9.9% annualized return and 10.5% annualized return if you have invested after market highs. This data shows you that you realize that the returns are slowly normalizing. It's kind of close to each other in terms of the impact. It is minimal. And then let's look at after 5 years, how does the numbers look like? After 5 years, it becomes, okay, if you have invested after sharp market declines, your annualized return will be about 9.6%. And if you have invested after market highs, the return now becomes 9.9%. From this, you can see that the impact from a difference of about close to about 2% after 1 year of investing after market decline versus market high, compared to 5 years later after you've done the investments, you realize that the returns have kind of normalized to a difference of only about 0.3%. So what I'm trying to say here is that it's not so important when you choose to start your investments. It is more important to look at how long you have to invest. Because if you have enough time horizon to write out your investments, you will be able to ride out through the market's ups and downs and different market cycles to capture the returns from the market over long periods of time. I hope that today's sharing gives you more assurance investing even during market highs. As usual, if you have any questions, please feel free to reach out to your client advisor. They'll be happy to discuss any questions you may have with you. As we enter into the month of December, I just want to represent Provident to wish all viewers a Merry Christmas and a joyous New Year. Thank you.